So imagine looking at a corporate earnings report, right?
Okay, I'm picturing it.
And you see top-line revenue just, barely crawling forward.
Like maybe 2% operational growth.
Exactly, 2%, which by most traditional metrics, you'd assume this is, a mature, arguably stagnant business just hitting a wall.
Yeah, treading water.
Right. But then you look a few lines down the income statement, and somehow, and this is the crazy part, earnings per share has violently spiked.
Up 24% year over year.
Yes, 24%. It totally defines the basic physics of business growth.
Because traditionally, you need to sell more things to make significantly more profit.
Exactly. And that tension, that weird disconnect, is exactly where we are planting our flag for today's deep dive.
It's a fun one.
Welcome, everyone, to this Special Talk Tickers edition of the Deep Dive.
Our mission today is to cut through the Wall Street jargon, right?
Yeah, we are stripping down the Q2 2026 earnings call for Gartner Inc.
Ticker symbol 8IT.
Right, IT. And our objective isn't just to, blindly recite their financial results.
Nobody wants that.
No, we want to deliver those data-forward, opinionated, actionable insights you need. We're going to dissect the actual mechanics of how a company operating in a super constrained macro environment manages to engineer that kind of bottom line explosion.
And Gartner is just a really compelling case study right now.
Why is that? Like, for the listener who maybe just knows them for the Magic Quadrant.
Well, their entire business model is basically tethered to corporate anxiety.
Oh, I like that phrasing. Corporate anxiety.
Yeah, because, they don't manufacture hardware, right?
Right.
They don't sell enterprise resource planning software or cloud servers. They sell executive confidence.
So when Fortune 500 leadership teams are terrified of making the wrong strategic bet.
Exactly. Specifically regarding technology, they pay Gartner for the right to move forward with certainty.
So really, analyzing Gartner's financials is effectively analyzing the collective psychological state of the global C-suite.
That's exactly how you should look at it.
Okay, well, let's get straight into the raw data then. Because that discrepancy between the top and bottom lines is the whole gravitational center of this quarter.
The headline numbers?
Right. So total revenue came in at $1.7 billion.
Which, as reported, is up 3%.
Yeah, 3%. But then when we strip out currency fluctuations, on an FX neutral basis, operational growth is just 2%.
Right, 2%.
Now, I have to play the skeptic here.
Go for it.
In a market where we are seeing tech giants and dynamic SaaS platforms pushing 15, 20, or even 30% growth, 2% just looks anemic.
It does. It looks like a company that's stalled out.
Yeah, like they're treading water.
Well, if you view Gartner strictly through the lens of hypergrowth tech stocks, then sure, 2% operational growth definitely appears sluggish.
Right.
But applying like a software as a service growth multiple expectation to an advisory and research firm, that's a category error.
Okay, unpack that for me.
You have to contextualize that 2% within the current enterprise spending environment.
Because it's tight right now.
It's incredibly tight. We are looking at a landscape where chief financial officers have essentially frozen net new discretionary spending.
Yeah, every software renewal is being scrutinized.
Exactly. Seat counts are being aggressively audited, and vendor consolidation is basically the primary directive for every CFO.
So in that specific environment, staying flat is actually a win.
Maintaining positive operational growth while your clients are actively shrinking their vendor footprints, that actually signals tremendous pricing power.
It shows they are indispensable.
Right. Flat is sort of the new up in this macro environment.
Okay, but let's talk about that currency headwind you mentioned.
Yeah.
Because the US dollar has been historically strong lately.
Very strong, yeah.
How much of that sluggishness is just an optical illusion created by foreign exchange translations?
It's a non-trivial factor. Gartner operates globally.
Right. So they're collecting subscription revenues in euros, yen, pounds.
Exactly. And Australian dollars. So when the US dollar is super dominant, the repatriation of those foreign revenues looks a lot smaller on a GAAP basis.
Even if they sold the exact same volume of research in Europe as they did last year?
Precisely. So management's emphasis on that 2% FX neutral growth, that's their way of isolating the core demand from the macroeconomic currency turbulence.
Got it. It tells us the underlying engine is actually still moving forward.
Yes, albeit slowly, but it's moving.
Which brings us to the elephant in the room.
The adjusted earnings per share.
Yeah. $4.37 for the quarter.
Which is up 24% from Q2 of last year.
Right. So if top-line revenue only dragged 2% more cash in the door, I mean, a 24% EPS jump requires some serious intervention.
Oh, absolutely. And that intervention was share buybacks.
They spent $547 million buying back their own stock in this quarter alone.
And that is the engine of the discrepancy right there.
It's wild.
Yeah, this isn't just a routine share repurchase program designed to, offset employee stock-based compensation dilution.
No, this is aggressive.
It's predatory share cannibalization. To put that $547 million into perspective, it allowed them to retire over 5% of their outstanding float in a single 90-day period.
Wow. And looking at the year-over-year data, they've shrunk the total share count by a staggering 14%.
Right. They've gone from roughly 75 million shares down to an unweighted 64 million exiting the quarter.
But here's my pushback on this strategy for you as the retail investor listening right now.
Okay, let's hear it.
They are deploying $500 million of capital to buy their own stock while the market is trading at or near all-time highs.
Yeah, that's the classic critique.
Right, because a buyback is fundamentally an investment in yourself. So if you are buying at a premium, aren't you technically destroying shareholder value?
It's a fair question.
Couldn't that $547 million be better deployed into research and development or just a massive strategic acquisition?
Well, that is the essential debate in capital allocation, right? Is buying your own stock at a 30x price to earnings multiple actually accretive?
Exactly. Is it?
Management's implicit argument here is that the public market is fundamentally mispricing their business.
Mispricing the durability of it.
The durability and the forward cash generation capacity. Yeah. They look at their own internal forecasting, which we will get to in a minute with their contract value metrics, and they determine that even at current valuations, Gartner stock is the highest yield asset they can buy.
Huh. It also suggests a certain level of discipline regarding M&A, don't you think?
Oh, absolutely.
Because in the consulting and advisory space, massive transformational mergers are notoriously difficult to integrate.
Yeah, you aren't just merging code bases.
Right, you're merging human capital, egos, different research methodologies. The friction is immense.
Precisely. I mean, the historical graveyard of professional services is just littered with disastrous mega mergers.
Right. So instead of taking on the enormous integration risk of buying a rival firm for $1 billion.
Which usually comes with massive goodwill write-downs later anyway.
Yeah, Gartner is choosing a mathematically guaranteed return.
Exactly. By reducing the denominator, the share count, by 14%, they guarantee that every remaining shareholder owns 14% more of the future free cash flow.
It's a completely risk-averse strategy, and it compounds brilliantly over time.
Provided the underlying business doesn't deteriorate, yes.
Right, assuming the core holds up.
Yeah.
So let's talk about the fuel for that strategy.
The free cash flow generation.
Yeah, because you can't buy back 14% of your company with just accounting profits, right? You need actual cold, hard cash.
You definitely do.
So EBITDA came in at $466 million.
Up 6% as reported.
But the metric that really stands out is their free cash flow conversion. They generated $378 million in free cash flow for the quarter.
Which is up 9% year over year.
Right. And on a rolling 4-quarter basis, they're sitting at $1.3 billion in free cash flow.
The conversion rate is the true anomaly here, honestly.
Yeah, break that down.
Well, they are converting 136% to 140% of their GAAP net income into free cash flow.
Which is insane.
It is. For a financial analyst, a conversion rate consistently over 100% is a massive signal of high-quality earnings.
Can you explain the mechanics of that for a moment for the listeners who might be newer to this?
Sure.
How does a company generate more cash than it actually reports in net income without taking on new debt?
It all comes down to the structural advantage of a subscription business model and negative working capital.
Okay, so a company signs a contract.
Right. Say a major enterprise signs a $500,000 annual contract with Gartner for access to their research library.
Yeah.
They typically pay that invoice up front. Gartner gets the $500,000 in cash on day one.
Right.
However, under generally accepted accounting principles, or GAAP, Gartner cannot recognize that entire $500,000 as revenue immediately.
Because they haven't actually delivered the service yet.
Exactly. They have to recognize it slowly, month by month, over the 12 months of the contract.
So the cash is already sitting in their bank account.
Yes.
Earning interest, while the income statement only shows a tiny fraction of it.
You nailed it. The net income figure on the income statement is depressed by deferred revenue, but the cash flow statement reflects the actual capital they have on hand to deploy.
That makes total sense.
And because they require very little capital expenditure, I mean, they aren't building semiconductor fabs or massive logistics warehouses.
Right, it's basically just analysts and servers.
Exactly. So almost all of that cash drops straight to the bottom line as free cash flow.
Which creates this perpetual cash machine.
A machine that funds the share repurchases without requiring them to touch their balance sheet debt.
Incredible. Which perfectly sets up the most critical forward-looking metric in this entire earnings print.
Contract value, or CV.
Right. Because if revenue is a lagging indicator looking in the rearview mirror,
then CV is the headlights.
Exactly.
Yeah.
So total contract value hit $5.3 billion.
Up 2% year over year.
But management spent a lot of time emphasizing that this represents a 70 basis point sequential acceleration from Q1.
And that 70 basis point acceleration is arguably the single most important data point in the entire transcript.
Why is that?
Because in a subscription business, the velocity of your contract value growth dictates your future revenue growth.
Right.
If CV is decelerating, it means your sales team is struggling to close deals and your future revenue will inevitably plateau.
But they are showing acceleration in Q2.
Exactly, which completely contradicts the broader narrative of a sluggish B2B software environment.
Yeah, because a 0.7% sequential acceleration might sound like a rounding error in a vacuum.
But on a $5.3 billion base, it represents a highly meaningful shift in momentum.
So it basically indicates that despite the prolonged sales cycles and despite the heightened CFO scrutiny we talked about earlier,
the pipeline is actually converting at a faster rate than it was 90 days ago.
Wow.
It suggests that whatever gridlock was holding back enterprise spending in Q1 is actually beginning to thaw.
At least for Gartner's specific services.
Right, at least for them.
So we have to ask the obvious question then. Why?
The catalyst.
Yeah. If the macroeconomic environment is still defined by tight budgets and extended procurement cycles, what is forcing these companies to sign the dotted line and accelerate Gartner's contract value?
Well, we have to look at the story behind the numbers.
And based on CEO Gene Hall's commentary, the entire narrative rests on one massive, unavoidable catalyst.
Artificial intelligence.
Of course it is.
It is the gravitational pull of the entire enterprise software sector right now.
Gene Hall explicitly noted that AI remains the single most requested topic by C-level executives globally.
But what's vital to understand here is the actual nature of these requests.
Right, because we are past the initial hype cycle, right?
Yeah, we're way past executives just wanting to know what ChatGPT is.
Now they actually have to use it.
Exactly. We are now in the deployment phase, which is vastly more complex and significantly more dangerous for a corporation.
Right, the stakes are exponentially higher now. Because it's one thing for a marketing department to use an AI tool to, brainstorm email subject lines.
If that messes up, no big deal.
But it's entirely different when a global financial institution wants to integrate a large language model into their customer service portal or their proprietary trading algorithms.
And that is exactly where Gartner extracts its value.
Because the risk is so high.
Massive. When a Fortune 500 company decides to allocate $20 million to build out an AI infrastructure, the operational and reputational risks are staggering.
Will the vendor they choose even exist in 36 months?
Exactly. Does the model hallucinate and offer illegal financial advice to clients?
Or are they inadvertently training a public AI model on their proprietary, highly regulated customer data?
Which is a CFO's worst nightmare.
So the paralysis we are seeing isn't necessarily a lack of budget.
No, it's a surplus of fear.
The C-suite is terrified of making a career-ending mistake.
Absolutely. The technology is evolving faster than corporate governance can possibly adapt.
Right. And during the Q&A on the call, an analyst actually probed this exact dynamic.
Oh, yeah. They asked if the massive capital expenditures companies are pouring into AI chips like cloud infrastructure were cannibalizing Gartner's share of the IT budget.
Right. The assumption being that if a CIO has to spend $5 million on NVIDIA GPUs, they might just cut their $200,000 Gartner research subscription to balance the books.
But management inverted that logic entirely.
How so?
They pointed out that Gartner's cost is a fractional rounding error compared to the total cost of a major AI deployment.
Often less than 0.1% of the total project budget.
Exactly. So when you are making a massive, highly visible, highly risky capital allocation, spending a fraction of a percent to have an independent, objective third party validate your strategy.
It isn't a luxury expense anymore.
No, it's a mandatory insurance policy.
It acts as an executive shield.
A shield, exactly.
Because if a CIO implements a new AI architecture and it fails catastrophically, but they can point to a Gartner Magic Quadrant report and say, hey, we followed the industry standard recommendation.
It diffuses the internal blame.
They are essentially buying risk mitigation.
That is the core utility of enterprise advisory. Gartner just sits at the intersection of three massive constituencies right now.
Okay, what are they?
You've got 80,000 business leaders looking for AI use cases to drive efficiency.
Right.
You've got 10,000 chief information officers actually tasked with securely implementing it.
Yeah.
And you've got 5,000 technology providers desperately trying to build and sell it.
And Gartner has visibility into all three nodes.
Exactly. They know what the vendors are building before it hits the market. They know what the CIOs are struggling to integrate, and they know where the business leaders are seeing actual ROI versus just empty hype.
That's a massive moat.
It really is.
Well, I want to drill down into who exactly is buying this insurance policy, because the transcript revealed a really fascinating divergence in customer demographics.
Oh, this was a great part of the call.
Right, because when we think of enterprise AI deployment, we usually picture the massive multinational behemoths.
The Fortune 50 companies.
Yeah, but Gene Hall noted that the real growth engine right now, across both their global technology sales and global business sales divisions, is actually the mid-sized enterprise segment.
Which grew in the mid-single digits year over year.
Yeah. So why are the mid-market companies outperforming the giants in terms of advisory demand?
It's a brilliant illustration of how organizational complexity acts as a headwind to technological adoption.
Okay, explain that.
Well, when Gartner talks about mid-sized enterprises, they aren't referring to like a mom and pop small business.
Right, they aren't local coffee shops.
No, their threshold for the segment is companies with revenues starting at $100 million and going up to $1 billion.
So these are substantial, heavily capitalized organizations.
Very substantial.
Right.
But they don't have the suffocating bureaucracy of a massive global conglomerate.
Ah,
Because a massive global bank operates across 50 different regulatory regimes, right? They have legacy mainframe technology stacks that were built in the 1980s.
oh man, trying to integrate AI into that.
Exactly. When they try to implement a holistic AI strategy, they spend 18 months just navigating internal compliance, legal reviews, and data siloing issues.
And furthermore, in the current macro environment, these massive enterprises are heavily focused on cost optimization anyway.
Which leads to a dynamic Gartner refers to as downselling.
Right, we need to define downselling clearly because that is the primary anchor dragging on their overall contract value growth right now.
Downselling occurs at the point of contract renewal.
Okay.
So a Fortune 500 client doesn't cancel their Gartner subscription completely. They still find it essential, but they reduce the scope of the engagement.
For example.
So last year, they might have purchased 100 premium analyst access licenses for their top executives. But after a round of corporate layoffs and budget tightening, they renew the contract for only 75 licenses.
So Gartner successfully retains the client logo,
Which is crucial, yes.
but the total annualized contract value for that specific account shrinks.
Exactly. And management noted that this downselling pressure remains heavily concentrated in their largest enterprise accounts.
But the mid-sized companies are immune to this.
Well, not immune, but they are operating with a totally different set of physics.
How so?
A $500 million logistics company is agile enough to actually deploy an AI routing algorithm, track the cost savings in real time, and realize the return on investment within a single quarter.
Wow, because they can move faster.
Because they can move faster and prove the value faster, their appetite for strategic guidance on what to do next is voracious.
They aren't stuck in compliance purgatory.
No, they are actively competing. Consequently, they aren't downselling their licenses. They are expanding their engagements to figure out how to leverage AI to punch above their weight class.
Trying to disrupt the larger, slower incumbents.
Exactly.
That dynamic really reframes how an investor should look at the B2B tech sector right now.
It does.
Because the assumption is always that you need to land the biggest whales to drive revenue.
But in a period of intense technological disruption combined with macro uncertainty, the mid-market is actually the velocity driver.
It is the absolute sweet spot of enterprise sales right now. Large enough to have significant IT budgets, but small enough to actually make a purchasing decision without requiring board approval for every single pilot program.
Spot on.
Okay, let's transition to another critical leading indicator that CFO Craig Safian spent a lot of time breaking down.
The engagement metrics.
Yes, engagement. He noted that overall client engagement is up 140 basis points compared to the same period last year.
Specifically, digital engagement improved by over 110 basis points.
Right, and human interactions, which I assume means direct consultations with their analysts, increased by more than 150 basis points.
That's right.
But why does management care so deeply about a 1.4% increase in platform logins? I mean, why did they focus on it so much?
Because in a subscription-based intellectual property business, engagement is the ultimate predictor of churn.
Okay, that makes sense.
If you are analyzing a SaaS company and the user login rate drops, you can guarantee with near mathematical certainty that revenue will drop 12 months later when those contracts come up for renewal.
Right. But conversely, if engagement is rising in a tight budget environment,
it proves the product is delivering daily indispensable value.
It's the difference between a gym membership you buy in January and forget about by March versus a personal trainer you meet with 3 times a week.
That is a perfect analogy.
When the CFO looks to cut costs, the unused gym membership gets axed immediately.
But the personal trainer who is actively helping you hit your goals survives the budget cuts.
Exactly. Management tracks these metrics obsessively because higher engagement today directly correlates to higher wallet retention tomorrow.
And they specifically highlighted that wallet retention stabilized and actually improved sequentially in the second quarter.
Break down the mechanics of that retention flywheel they discussed during the Q&A.
Right.
Because an analyst asked how they plan to pull out of this low single-digit growth slump and re-accelerate toward historical norms.
And their entire thesis rested on this engagement to retention pipeline.
Right. How does that math work?
The math is unforgiving. If a company has a leaky bucket, meaning they have high churn and are constantly losing clients, their sales team has to work incredibly hard just to replace the lost revenue before they can even think about growth.
It's like running on a treadmill just to stay at zero.
Exactly. So by driving engagement up, Gartner plugs the holes in the bucket.
Right.
Once retention stabilizes, every single new client the sales team lands is purely additive to the top line.
Furthermore, a highly engaged client is significantly easier to upsell, right?
Oh, absolutely. If a CIO is already logging in daily to read AI research, it is a much easier conversation for the account executive to sell them an additional module focused on cybersecurity.
Which brings us to the internal operational changes Gartner is making to actually drive that engagement.
The BTI transformation.
Yes, business and technology insights. They are fundamentally restructuring how they produce and deliver content.
They increased their insights library document count by 18%.
But more importantly, the volume of what they classify as higher impact documents is up double digits.
Right. And they also emphasize drastically reducing the time it takes to publish analysis after a major industry event.
That speed to market is so critical right now.
It really is. The traditional model of enterprise research involved deep, exhaustive reports that might take 3 months to publish.
But technology cycles have compressed so much.
Exactly. If a major cloud provider announces a fundamental shift in how they price their AI compute infrastructure on a Tuesday, a CIO needs actionable advice on how to respond by Wednesday morning.
Right. If Gartner waits until the end of the quarter to publish a white paper on it, the insight is already stale.
It's functionally useless by then.
So they are basically shifting from being a library of record to becoming a real-time strategic news desk for the C-suite.
That's a great way to put it. By dramatically accelerating the timeliness of their insights, they force the client to rely on them continuously.
Rather than just periodically when they are planning their annual budget.
Right. And this operational shift feeds directly into the digital engagement metrics, which in turn secures the retention rates.
Speaking of digital engagement, there was a particularly revealing exchange during the Q&A regarding a new feature called Ask Gartner.
Oh, yeah.
An analyst wanted to know if this tool was driving higher renewal rates. From the context, it sounds like an internal AI-driven semantic search or chatbot designed to navigate their proprietary research library.
It is. And the analyst was likely fishing for a narrative about how Gartner is leveraging AI internally to drive massive efficiency gains.
Right. Everyone wants that AI boom story.
Right.
But management's response was refreshingly sober.
Very sober. They essentially categorized Ask Gartner as table stakes for a modern digital platform.
They didn't pretend it was some revolutionary paradigm shift.
No, they were incredibly pragmatic about it. I mean, in 2026, if you have a massive, complex database of unstructured text, which is what a research library is, your clients expect a large language model interface to query it.
Yeah, the days of Boolean search strings and clunky keyword filtering are just over.
Providing a conversational AI interface is just the baseline expectation for user experience now.
It reduces friction, which is nice, but it isn't the core value proposition that convinces a CFO to sign $1 million contract.
Exactly. It's the classic distinction between the delivery mechanism and the actual payload.
Because the smartest AI chatbot in the world is utterly useless if it's querying a database of mediocre publicly available information.
Right. The moat isn't the natural language processing algorithm. The moat is the 40 years of proprietary, expert-vetted analysis.
And the millions of proprietary data points they gather from their clients every year.
Precisely. And management actually pushed back on the idea that reactive search, even AI-powered search, is the future of their business.
What do they say?
They emphasize that their true premium lies in proactivity.
Proactivity, okay.
Because a Gartner analyst might speak to 50 different CIOs in a single week across multiple industries.
Wow.
So they can identify macro patterns and emerging bottlenecks before an individual client even realizes they have a problem.
So the chatbot can only answer the question you know to ask.
Yes.
But the human analyst tells you the question you should be asking, but aren't.
Exactly. And that proactive pattern recognition capability derived from immense scale. That is something an internal enterprise chatbot simply cannot replicate.
Because the chatbot only has access to the company's internal data.
Right. It doesn't see the entire chessboard the way Gartner does.
That makes total sense.
Okay.
Let's pivot from how they are operating today to what they are promising for tomorrow.
Segment 3, management guidance.
This is where the rubber meets the road for Wall Street. Did they sandbag their estimates, or are they genuinely confident?
Well, the headline here is that they didn't just meet expectations for Q2.
No. They raised their full year 2026 guidance across almost every major metric.
And raising guidance in an environment that they themselves characterize as plagued by macroeconomic uncertainty and delayed decision-making, that is a massive flex of corporate confidence.
It really is. So let's look at the revised figures. They raised their full year adjusted EPS guidance to at or above $14.
Right.
Now, we have to acknowledge that this EPS bump is heavily manufactured by the aggressive share buyback program we discussed earlier.
Yeah, we can't ignore that.
The operational business is growing slowly, but the denominator is shrinking rapidly, forcing the per share value up.
That is undeniably true. But they also raised the raw profitability metrics.
Which ones?
Full year EBITDA is now expected to be at or above $1.57 billion.
Okay, that's significant.
And more importantly, the free cash flow guidance was raised to at or above $1.185 billion.
So even if you strip away the financial engineering of the buybacks, the core business is generating more raw cash than they initially projected at the start of the year.
Exactly.
What about the revenue side, though? Because that seems to be the one stubborn metric.
Yeah, total revenue is projected at or above $6.375 billion.
But they explicitly noted this represents an FX-neutral growth of just 1%.
Right, which requires a nuanced reading of the transcript.
How so?
The raw reported revenue is undeniably facing severe headwinds from the strong U.S. dollar, which acts as a heavy anchor on their global performance.
Sure.
However, management is urging investors to look past the lagging revenue indicator and focus on the forward-looking contract value.
Right, the CV we talked about earlier.
They are explicitly projecting that CV growth will continue to reaccelerate sequentially throughout the third and fourth quarters.
So they're essentially saying, look, the revenue numbers look soft right now because of currency and the hangover of Q1 sluggishness, but the deals we are signing today will pull that revenue growth up in 2027.
That's exactly their argument.
But to achieve that acceleration, they have to fix a major leak in the ship, which is their U.S. federal government business.
Oh, yeah, the federal sector.
There's a very specific carve-out in the transcript discussing this. They noted that if you exclude the U.S. federal government, their CD growth was actually 3.3%.
Which is significantly higher than the blended 2% average.
Yeah. The federal CV sits at about $125 million and has clearly been a major drag on the overall business.
The federal government is a notoriously difficult client.
Understatement of the year.
Yeah, and analyzing government contracts requires an entirely different framework than enterprise sales.
Right, because government procurement isn't driven by market competition or the sudden need to implement AI to beat a rival.
No, it's driven by legislative budgeting cycles, continuing resolutions, and just staggering bureaucratic friction.
Like FedRAMP compliance requirements for cloud services.
Exactly. And over the past year, the U.S. government has been operating under immense budget uncertainty, threats of shutdowns, delayed appropriations.
It completely freezes procurement.
Entirely. When a federal agency doesn't know what their budget will be next month, they do not sign new multi-year advisory contracts. They pause everything.
Which created a massive headwind for Gartner's federal division over the past 12 months.
It did. However, the critical takeaway from the Q2 transcript is that this headwind is finally dissipating.
Right. Management highlighted that they actually saw a positive net contract value increase, or NCVI, in the government sector this quarter.
Oh, so the bleeding has stopped.
More than that, actually. Because the federal business performed so poorly over the last 4 quarters, the comparative baseline is now incredibly low.
Ah, I see where you're going with this.
Yeah, as they move into the back half of the year. And keep in mind, Q3 is the end of the U.S. federal fiscal year, which is typically when agencies rush to spend their remaining budgets.
The federal division transitions from being an anchor dragging down growth to a tailwind accelerating it as they lap those easy comps.
Exactly. So when you combine the stabilization of the federal sector with the mid-market agility and the relentless AI demand,
You start to see why management is comfortable projecting acceleration.
which brings us to a massive long-term promise that CFO Craig Safian made on the call.
Oh, this was bold.
He stated that Gartner expects to deliver adjusted EPS growth on a compound annual basis above 12% over the next 3 years.
A 12% CAGR over a 3-year horizon in a sluggish macroeconomic environment.
Yeah.
That is the hallmark of a premier compounder stock.
And they didn't just throw that number out as a hope. They laid out the exact mathematical roadmap for how they will achieve it.
And it all traces back to that elite free cash flow conversion rate we discussed earlier.
Let's run the numbers on that war chest. They have roughly $1.5 billion of cash sitting on the balance sheet.
Right.
And management noted they only need about $500 million to run the day-to-day operations of the business, manage working capital, and handle short-term liabilities.
Which leaves a massive, unencumbered $1 billion available to deploy purely on behalf of shareholders.
That's a lot of ammo.
It is. And their capital allocation framework for deploying that $1 billion is ruthlessly disciplined.
It operates on a 2-pronged strategy, right?
Yes. The primary lever, as we've beaten to death, is the continuous, relentless share repurchases.
And to underscore their commitment to this, the board of directors just increased the buyback authorization to a staggering $1.2 billion.
They basically have a blank check to keep shrinking the denominator, mathematically forcing the EPS higher, even if top-line revenue remains muted.
The second lever is M&A. But earlier we talked about how large-scale acquisitions in this space are often value destructive.
They are.
So how are they approaching M&A differently to ensure it's actually accretive to that 12% EPS goal?
They are executing a strategy of strategic, value-enhancing tuck-in M&A.
Meaning?
They are emphatically not looking for transformational mergers that require them to integrate thousands of new employees or reconcile entirely different corporate cultures.
Right, no mega mergers.
Instead, they look for highly specialized niche data or consulting firms that possess proprietary data sets or deeply specialized industry expertise.
So they acquire these small firms and just immediately plug their unique data into the massive Gartner distribution machine.
Exactly. It's an arbitrage play.
Explain that arbitrage.
A boutique AI consulting firm might have brilliant insights, but they only have access to 50 clients.
Right.
Gartner buys them, takes that same insight, and instantly distributes it to 10,000 CIOs globally.
Wow. So the value of that intellectual property skyrockets the moment it plugs into Gartner's network.
Exactly. It's highly capital efficient M&A that immediately enhances the core value proposition of their subscription product,
driving further engagement and retention.
And they are incredibly disciplined about it. If they don't see a tuck-in acquisition that perfectly fits that model and meets their strict return thresholds, they don't force a deal just to show revenue growth.
They simply take that cash and funnel it back into the buyback machine.
Precisely.
Before we move to our final verdict, I think it's important to briefly touch on the other 2 segments of their business conferences and consulting, just to ensure we aren't missing any structural weaknesses outside of the core research subscription model.
The conferences segment is actually a fascinating bright spot.
Right. Revenue came in at $240 million, which is up about 12% on a same conference basis, FX neutral.
Which is incredible when you consider that 5 years ago, people thought virtual meetings were going to permanently kill corporate travel and in-person events.
Yeah, I remember that narrative.
Oh, yeah. But it turns out that when dealing with highly complex, rapidly evolving topics like generative AI integration, human beings still crave high bandwidth, face-to-face networking.
Because executives want to sit in a room with their peers off the record and figure out what is actually working and what is pure vendor hype.
Exactly. And the conference business acts as a massive lead generation engine for their core subscription business.
And what about the consulting segment? Revenue was $142 million, but the metric that caught my eye was the backlog.
Yes, consulting revenue is generally project-based and lower margin than the subscription research, but it serves a crucial purpose for deep, customized implementations.
And the key leading indicator here is that the consulting backlog grew for the first time since Q1 of 2025.
Right. Backlog is up 9% year over year to $214 million, and new bookings increased by 17%.
So across all three divisions, the massive research subscription base, the in-person conferences, and the customized consulting engagements, the forward-looking indicators are all pointing up and to the right.
The engine is primed across the board.
Which brings us to the synthesis of all this data.
It is time for the final verdict.
Segment 4, the bottom line.
Here we go.
We have waded through the income statements. We've debated the merits of shrinking the share float at all-time highs. We've unpacked the mid-market AI tailwinds, and we've analyzed the federal procurement drag.
We've covered a lot of ground.
So I'm asking you to synthesize this entire Q2 print. For the retail investor listening to Talk Tickers right now, are we bullish or bearish on Gartner's position heading into the back half of 2026?
Based on the structural mechanics of the business revealed in this transcript, I have to take a firmly bullish stance.
All right, construct the argument. I want you to defend that position against the obvious bearish critique that this is just a slow-growth legacy company artificially propping up its stock price.
Fair enough. The bullish thesis rests on three unassailable pillars.
Okay, pillar 1.
The first is elite capital efficiency. Management reported a 31% return on invested capital, or ROIC, on a rolling 4-quarter basis.
31%.
Yeah. That means for every single dollar of capital they deploy into the business, they generate 31 cents of profit annually.
I'm going to push back hard on that metric.
Let's hear it.
Generating a high ROIC in an advisory business isn't necessarily a massive achievement. It's just a structural reality of the sector. They don't have to build billion-dollar fabrication plants. Their primary capital expense is human analysts, which are expensed on the income statement, not capitalized on the balance sheet.
That's right.
So naturally, their invested capital base is tiny, which artificially inflates the ROIC percentage. Isn't that 31% just a mirage of accounting?
That is a very sophisticated bearish argument, and it is true that service businesses naturally have higher ROIC than industrials.
Right.
However, even within the universe of asset-light professional services and software, 31% is an elite tier of profitability.
You think so?
Absolutely. Many consulting firms struggle to maintain 15 to 20% ROIC because they constantly have to overpay for talent or make aggressive acquisitions just to maintain growth.
Okay, I see your point.
Gartner's 31% proves that their specific intellectual property has massive operating leverage. They can write one piece of brilliant research and sell it 10,000 times with zero marginal cost of reproduction.
So that isn't an accounting mirage, that is a definitive structural moat. Fair enough. What is the second pillar?
The second pillar is the absolute resilience of the core product in a hostile environment.
We talked about this.
Yeah. We are in a macro climate where CFOs are actively hunting for software subscriptions to cancel. They're consolidating vendors and demanding immediate hard dollar ROI for every expense.
And in that exact environment, Gartner is not only maintaining its massive $5.3 billion contract value base, it is accelerating its sequential growth.
That empirically proves that the global C-suite views Gartner's independent insight not as a discretionary luxury, but as mission-critical infrastructure.
They are the mandated insurance policy for the AI revolution.
Precisely.
And the third pillar?
The third pillar is management's absolute unwavering commitment to financial engineering on behalf of the shareholder.
The buyback.
The buybacks. They aren't hoarding cash to build an empire, and they aren't incinerating it on foolish ego-driven acquisitions. They are methodically and aggressively cannibalizing their own share count. When you combine a business that generates over 130% free cash flow conversion with a management team authorized to deploy $1.2 billion to shrink the denominator,
you have created a mathematical compounder that forces EPS higher almost regardless of top-line macroeconomic headwinds.
You said it perfectly.
So let's distill this into a highly actionable takeaway for the retail investor listening right now.
So what?
Right. We spend an inordinate amount of time analyzing how to invest in the artificial intelligence paradigm shift. The instinct for most investors is to try and pick the ultimate winner.
Do you buy the semiconductor designers, the chip fabricators, the hyperscale cloud providers?
Or do you try to guess which nimble sauce startup will build the killer application that disrupts the incumbents?
And engaging in that kind of stock picking is incredibly hazardous. You are trying to predict the outcome of a technological war where the battle lines shift every 3 months.
And the capital requirements to compete are measured in the tens of billions.
The risk of backing the wrong horse and seeing your investment zeroed out is immense.
But Gartner represents an entirely different angle of attack. To avoid the exhausted cliches about gold rushes, let's think about this like a casino.
Okay.
You don't want to be the gambler trying to predict whether the roulette ball will land on red or black.
Right.
You want to be the house, taking a fractional percentage of every single bet placed on the floor, regardless of who wins or loses the hand.
That is a phenomenal framework. Gartner doesn't care if Microsoft's language model defeats Google's or if an open source startup disrupts both of them.
Exactly.
Gartner's revenue isn't dependent on a specific technological outcome. It is dependent on the confusion and anxiety generated by the competition.
Because as long as the AI landscape remains chaotic, fragmented, and terrifying for corporate executives to navigate,
those executives will pay Gartner massive premiums to guide them through the casino.
You are investing in the toll booth on the highway to AI integration. Every major enterprise in the world has to drive down that road, and Gartner is perfectly positioned to collect a fee from every single one of them.
It is a high-margin, cash-printing business model that heavily rewards investors who understand the mechanics of long-term compounding.
And importantly, the moat protecting that toll booth is incredibly wide. You cannot simply raise venture capital, build a slick website, and convince 10,000 global chief information officers to trust a 24-year-old startup founder with their multi-million-dollar IT roadmaps.
No, trust at the enterprise scale requires decades of verified, objective performance.
Gartner has spent 40 years building that credibility. It is an intangible asset that is nearly impossible for a new entrant to replicate quickly.
Absolutely.
Well, that brings us to the end of our comprehensive breakdown of Gartner's Q2 financial architecture.
We covered a lot today.
We did. We've dissected the cash flow mechanics, challenged the top-line narrative, and hopefully provided a much clearer picture of how this specific business navigates turbulent economic waters.
But before we close out this deep dive, we have to leave you with one final, deeply provocative thought to analyze regarding your own portfolio.
The existential horizon.
Exactly.
Throughout this entire hour, we've highlighted how Gartner is currently extracting massive profits by acting as the human translators for the artificial intelligence revolution.
Right. Their analysts are the essential bridge between complex tech and frightened executives.
But we have to acknowledge the paradox inherent in their success.
Because the fundamental nature of what large language models do is ingest unstructured data, synthesize it, recognize hidden patterns, and output clear strategic summaries.
Right. So the ultimate question is this. At what point does the underlying technology become sophisticated enough to replace the consultant?
That's $1 million question.
If an AI model reaches a state where it can instantly ingest real-time pricing benchmarks across the entire global software market, cross-reference it against the specific regulatory constraints of a client's industry, and instantly output a tailored, highly accurate strategic roadmap, what happens to the human analyst?
It forces us to ask if the human element of advisory, the relationship, the empathy, the nuanced understanding of corporate politics is a permanent necessity, or just a temporary gap filler until the algorithms achieve true autonomous reasoning capabilities.
Does the product Gartner is currently advising companies on eventually become the very mechanism that makes Gartner's core business model obsolete?
It is the ultimate innovator's dilemma.
Will the very catalyst driving their record-breaking free cash flow today eventually evolve into their greatest existential threat tomorrow?
Something to think about.
As you review the holdings in your own brokerage account this week, we challenge you to apply that same rigorous lens. Ask yourself, which of the companies you own are truly immune to the long-term disruption of the technologies they are currently profiting from?
A balance sheet might look pristine today, but you always have to consider what the architecture of the industry will look like in a decade.
Keep interrogating the data, keep demanding structural explanations over superficial narratives, and we will catch you on the next deep dive.